So I think my mic is working. Okay. Well, good morning again, everyone. Thank you for sticking around for the first panel of the morning, which is the corporate world reemerging, pandemic recovery, and moving towards a more sustainable finance agenda. I have a great panel with me today, and the one key thing I would say is, as we were prepping for this, we had way more material than we could possibly have done in the amount of time that was allocated. So you're going to see a lot of enthusiasm from the speakers around the various topics that are available here. The housekeeping items, as Andy said, up front, the web app for questions. We'd welcome them throughout, and certainly we'll try to allocate some time. But as I said, there's a lot of information to cover here as we look at this topic. So I'll start with a quick round of introductions. I'll let everyone speak. As mentioned, I'm the Joseph Lau, the chair of the Fixed Income Investor Network, as well as the president of Lord Cap Green, a dedicated asset manager that focuses on commercial properties for energy efficiency, renewables, and resilience. Manish.
Great. I'm Manish Kapoor. I'm the managing principal for West Wheelock Capital and also the vice chair for the Fixed Income Investor Network. And my focus really has been on alternative assets and finding ways to bring liquidity and scalability to them. So, including some of the asset classes in ABS, which now are vanilla, for example, solar, wind, and I kind of keep focusing on that, finding other asset classes which are illiquid and finding ways to bring scalable funding to them. So it's great to be here. Look forward to discussing these themes in the panel today. On to you, Chris.
Thanks, Manish. My name is Chris Creed. I'm a senior advisor at the Department of Energy's Loan Programs Office. We're responsible for helping provide senior financing to emerging energy technologies in the United States. I joined this summer. Before that, I just finished up 21 years at Goldman, where the last 12 of which I was co-head of our mortgage and ABS investment business at the asset manager. So great to be here and look forward to the discussion.
Hi, my name is Keith Kennerly, and I'm the founder and CEO of an emerging company called PayRx Finance. We focus on the healthcare space and really bringing about sustainable healthcare financing. Our primary focus is dealing with what we call those rare occurrences, unattainable needs in the community, for which we often find ourselves dealing with global issues around whether it be the pandemic and or bringing about new technology to enable people to be curative in nature. I share this because it's exciting to figure out ways to blend great science and finance. And I think that the structured finance market is a great place for which we can take the risk and help people be curative in nature. Prior to launching this firm, I ran a business at Hanover Re focused on healthcare financial solutions. Prior to that, I was at Aetna working in the CFO's office, working on strategic financial initiatives. And prior to that, I was at Lehman Brothers focused on structured finance. Pleasure to be here.
Good morning. My name is John Devaney. I'm the CEO and founder of United Capital Markets. We're a broker-dealer that's a secondary market maker in the structured finance bonds that we have engineered and packaged throughout several decades. We specialize in trading the subordinate and mezzanine pieces. We create advanced modeling and research and have specialized across many of the banged up areas throughout many of the years. We've traded about 80 billion of securities over my firm's history. We've traded about 2.5 billion in the hard hit CMBS area since the COVID pandemic has hit, mainly in the riskier subordinate and mezzanine slices. A bit about IMN. I really can't thank IMN enough. I've been attending these conferences now, I believe, for 21 years, not in a row. I've missed a few of these, but the educational format of IMN, I can assure you, has helped grow my company and all of our volumes tremendously over so many years. I've learned so much on the panels. I was told many of my employees over the years that limiting all the going out at night and getting up and getting a pad of paper and attending the panels can teach all of us so much. And I've sat in so many panels that were put on by IMN over the years and gained so much knowledge and perspective sitting in the front row taking notes over many, many years. And I just want to thank IMN for putting these on. And I think that these conferences have been a very important part of my company's success.
I would agree. Thank you, everyone. So as we start, the first issue that we had discussed was really around the idea of what are the key things that are necessary in order to progress the structured finance market when we think of sustainability. And there were really three topics that seemed to emerge from all of our discussions, and that was really the measurement of variables that were necessary to facilitate the use of this type of financing around the products that we have. Data, which as I mentioned this morning is obviously key and core to everything that we do, and then verifiability. And I personally think that is something that, besides there being no standard in the US for, is going to still be subjective for now. You know, whether that's a third party coming up with what they define as objectivity, or an organization defining their own views on what verification ends up being, that's still a state of flux. So when we discuss these items, all of those tended to come through the various parts of the discussion. So as we begin thinking about securitization in the context of sustainability, Chris, securitization is one of the larger asset classes addressing housing, consumer, and commercial credit, yet ESG integration has been slow. If anything, we've seen much of energy efficiency, renewables, and the like coming through more areas like infrastructure financing markets. How do you see us reconciling these so the ABS market can do more to facilitate these functions?
Yeah, no, I appreciate the question, Joe, and it's actually really interesting. There's a few different things that I might want to hit on. The first, not to get super technical this early in the morning, but Executive Order 14030, right? The comment period ended yesterday, so for those of you who manage ERISA money, you're going to be required to take into account climate-associated risks with the management of ERISA money. And I think that when you think about ESG integration and how you do that, I think the structured finance market is actually quite well positioned to lead that. We already have, especially in the residential mortgage space, but across almost all of our sub-asset classes, an enormous amount of data. We can benchmark. We can look at investments versus benchmarks. We can design good metrics to improve upon those benchmarks and then report on them. And so I think that's going to be something that we're going to have to do more and more and more of as a broad industry. The other thing, and speaking quite selfishly from the Loan Programs Office at the DOE, one of the things that the Loan Programs Office has done very well in its coming up on 15, 16 years of existence is project finance senior financing. But that's not a particularly big river asset class. When you think about the way in which we finance the world, right, the big river asset classes aside from sovereign financing are securitization and corporate, either in the bond or bank loan space. And so one of the things that we're looking at is how can we help the companies, the emerging technologies that are coming to us, gain access to larger river forms of financing, namely ABS or other types of securitizations. So as we think about ways to incorporate that, I think it dovetails quite nicely into Joe's question, which is, how can this market lean into other areas that maybe they haven't as much and accomplish some of the broad objectives that we all have going forward.
Thank you. John, what do you see as the outlook for consumer and corporate credit in the U.S., and what areas have exhibited resiliency or struggled during the pandemic period?
Wow. The COVID pandemic, as we know, had shocked the equity markets and rattled the corporate bond markets for both investment grade and high yield corporate credit risk. It sent shockwaves through the entire subordinate and mezzanine parts of ABS, RMBS, CMBS, CLO, Most of the BB rated pieces across those 4 subgroups I've mentioned traded down into the 40s and $50 price back shortly after the pandemic had unfolded, creating a very big issue with liquidity across many of the levered players. It seemed as though maybe we were in a death spiral of forced unwinds from leveraged financial players. In fact, many financial players were liquidated by repo counterparties during that initial period. Fortunately, we flash forward 20 months and the RMBS, the ABS, and the CLO markets in that BB, which is pretty much the riskiest slice in most of these deals, have completely recovered at this time into the 90s prices. If not, they're over most of those categories. They're almost at all-time tights, brought on in part by the very large government bond buying and stimulus that's hit the market with a very, very great amount of impact. So the corporate balance sheets across America are very healthy at this time. There's adequate funding. The one area that hasn't recovered in structured finance is in CMBS. The COVID pandemic has made certain types of CMBS assets become sick, just like the COVID has made many of us sick. Namely, hotels that had occupancy fall to 10% and closed malls that were shut down. The BBB and BB slices that I'm very active in trading in the conduit markets are trading. The BBBs are at an average price for the ones that are maturing in the next 5 years. They're trading at an average dollar price of about 70. The BB slices, unfortunately, are trading at about 50. And so those markets have not recovered. I could shed some more light on the enclosed mall area later on. And then second, to answer the second part of your question about the health of our consumer, this is the really bright spot for all of us and our economy and our financial markets. The government actions and stimulus have been very effective. Residential real estate are setting all-time highs, helping all of us feel a bit wealthier. And it's not caused by aggressive lending practices that had occurred before the financial crisis, increasing the available dollars for loans. In fact, we currently sit here today and the average LTVs are pretty much as low as ever. Our real estate markets are extremely healthy. There's a problem with supply and demand and a terrible problem with affordable housing across the United States. This wealth effect caused by residential real estate is creating incredible confidence in the consumer, and it's creating a consumer spending boom that is creating quite a bit of inflation across many markets that we've all been experiencing in both service and automobiles and housing related products. The stock market is at an all-time high. Again, that's creating an incredible wealth effect that is creating this consumer spending boom that I expect to continue for a couple years into the future. The consumer, as we should all remind ourselves, is the real big driver of our economy. They're responsible for about 70% of all the GDP, one way or the other. And so the health of the consumer is on very solid footing, and I expect that to stay that way for a couple years.
Thank you. Keith, turning the conversation a little bit, typically whenever we talk about ESG, the focus is on the environmental side, but it really misses the importance of the social aspects of ESG, the S, as everyone calls it. How might securitization evolve as a result of the pandemic to focus on the social component more?
When I think of structured finance, I think it can be applied many different places. As John walked us through the market of CMBS, RMBS, I can only think of how resilient the structured finance market is through different times. When I think of ESG, I think of it not just locally, but globally. I think of all the OECD countries And I think that healthcare is probably, if not one of the largest industries. And when you measure it, looked at on the basis of GDP, it represents about 6% today. And that number is only going to grow by 2030. It's going to be close to 10%. But as you go under the hood and you think about all the other countries that may not be part of that sort of conglomerate, I think about other aspects. I think about how do we improve health to wealth? How do we think about what's the biggest driver for poverty is lack of health. And so when I think of where we are in structured finance and the great tools used, whether it be for project finance, whether it be for different types of communicable diseases, even the pandemic, there's this huge disparities. And I think that as we think of the social component of ESG, it's starting to become more and more the mandate. So whether it be influenced through people trying to think about where they put their risk of money, or thinking about where they want to do what we want to think about in terms of societal component, I think there's great good, not just a matter of having some type of impact in financing, but I think that the structured finance market is ripe for taking on new types of innovations. And I think that the market that I focus on, where I'm working with those who are bringing about great sciences to help things be curative. We didn't talk about the pandemic. We're here in the US, we think about developed countries. Undeveloped countries are going to be set far, far behind. And I just truly believe that some of the resilience that John talked to can be redeployed in very unique ways over the next 10 years to help bring those countries about.
Yeah, thank you. And Manish, John touched on various sectors that are resilient and struggling. What's your opinion on this, and how do you see government involvement having impacted many of these structured sectors in the last couple of years?
To answer that question, I think first it's good to step back and think, what do the capital markets represent? What do the markets represent? And a lot of people say the markets are a pricing engine, whether you're looking at CMBS, credit cards, or something more exotic. I would actually disagree with that. I think what the markets really reflect is the fact that they're an emotional sensor. They're really reflecting the emotions, because we all live and die by our Excel spreadsheets, but then anytime a deal is oversubscribed, the Excel spreadsheet goes out the door. So I think first and foremost, I would say the markets really are a reflection of the emotions of the consumer, the politicians, and the issuers. The second point, I think is important is, it's kind of, to me, irrelevant what the price is today. Where, someone asked me, where is CMBX? And I said, just look it up yourself. What's really important is, where do you think the market will be 1 year from now, 2 years from now, 4 years from now? And to me, what's fascinating is, we just lived through a COVID pandemic where intelligent people saw the same data and came to radically different conclusions. This is in the same country, in same cities, in the same family, in the same asset manager. So not to channel my inner Donald Rumsfeld, but we have some unknown unknowns. There are things we don't even know that we don't know, and there is no way for us to know. But there are some known unknowns, which history repeats. So for example, predicting macro is very difficult. The path to bankruptcy is paved with hedge funds, which thought they could predict macro. But I think what we can do is do very granular level due diligence in terms of, you can put a range of outcomes in terms of a particular bond, a CUSIP, or a portfolio of assets, and work around that. But there are a couple of things I would highlight, where there are a few things which have been in the works pre-COVID, where you have brand new businesses, silos which did not exist earlier. So, as an example, the Apple App Store generates roughly $50 billion in revenues. And that's bigger than the GDP of quite a few countries, including my favorite, Bermuda. And that did not exist earlier. So you have new branches of the economy which did not exist earlier, and they're driving growth. Second, you have more and more companies accessing the capital markets early in the life cycle. So, basically the tried and tested pathways was, you would start with Series A, go down to F, and then kind of bank funding, and then you start doing securitizations. You've kind of started seeing the inverse. A lot of companies go to Series C, and then they're accessing securitization to get scalable capital market funding. Third is a lot of what's going on in the market, across the board, whether it's consumers, whether it's resis, corporates, is driven by effectively 0% and adjusting for inflation negative interest rates. Interest rates are such a common tool, but so powerful that we sometimes don't think about it. An interest rate is basically a time machine in the sense that low interest rates are a very easy way to borrow from the future. You're effectively front-ending growth. Therefore, at some point, you would expect growth to slow. And the question is, how do you expect that growth to slow, and which sectors will be more affected, which sectors will be less affected? Lastly, and I think most importantly, this market to me is not about the cost of credit, it is about the availability of credit. It really is a tale of two cities. Where we saw this last year, companies which had their entire business model not reduced, but effectively destroyed, going to 0% revenue, especially companies which are in the travel sector, were able to raise enough funding effectively to have a pathway well into the end of this year. Whereas a lot of small businesses could not access all the government facilities and therefore had issues. Every weekend, I have this routine since last April. I do this walk in New York. I start at downtown. I prostrate myself in front of Goldman Sachs headquarters. And then I walk all the way through Times Square and Midtown and Upper East Side into Harlem. And you still see a lot of pain and decimation, and it's unequal, where a lot of stores which are franchise stores or funded by big corporates are doing well. The story is not so great for some of these small businesses. So now kind of pulling that back to ABS. It's not a coincidence that the government funding, which really was directed to individuals and corporates, caused those sectors to do very well. Where I joke with some of my friends in Lev Finance that the next iteration of Covenant Light is an optional principal repayment clause. But it's not surprising that these sectors are doing well, whereas other sectors which were not directly funded, such as CMBS, have suffered some pain. So on CMBS, I do think there are some of those assets which will come back, but you really have to do a lot of granular due diligence. Some of these are still like catching falling knives. But that's kind of my broad thoughts on the market.
Thank you. Manish, we'll stay with you, but focus the topic a little bit, given commercial real estate is such an important area of focus, and we've all experienced working from home in various ways in the last couple of years. Are we really facing a new normal, or are we going to revert back? And what do we think the impact is going to be on the securitization market for a commercial mortgage based on that expectation?
I think for certain sectors in CRE, there was a structural shift underway pre-COVID. And for other sectors, COVID kind of turbocharged the shift. So, I think a good analogy is think of the newspaper business since 2000, when the internet really started. How well have newspapers done? How many newspapers which you remember from your childhood exist today? And how many of them have made the subscription model work? For example, in the US, of the newspapers considered the newspapers of record, only one has really made the subscription model kind of accretive. So, let's break down CMBS. So I think it's, first of all, very sector-specific, city-specific. In terms of malls, there was a secular shift away pre-COVID, with a lot of shopping moving to the online world. Having said that, you look at some of the warehouse fulfillment centers, which not just Amazon, but a lot of other players have brought online, not in the last 2 years, but in the last 5 years. That's a very substantial number. So there's a shift away. In terms of the office side, again, I think numbers are your friend. Let's break it down. The U.S. economy is 20 trillion plus minus 1 trillion, but what's $1 trillion among friends? The New York metro area is responsible for 2 trillion of that. Boston, $500 billion. LA, 1 trillion. San Francisco, $500 billion. So that's roughly 4 trillion. That's 25% of the US GDP. That's the engine which drives the US economy, and that's where the growth occurs. So a lot of the trends there drive the marginal demand and supply curve. And you look at New York and San Francisco office market as an example. Again, tale of two cities. I was in San Fran 2 weeks ago, and it still feels like a ghost town. New York, you see the banks trying in a very significant way to bring people back. And New York feels like it's 70, 80% pre-pandemic. So I think you cannot talk about the office CRE market. You really have to get down to the city level, down to the MSA level. But there are some secular shifts in CRE which are here to stay. There certainly are some good bargains to be had. But you really need to spend a lot of time digging through not just the numbers of the particular QSIP or the portfolio you're looking at, but just some of the trends in the area.
Makes sense. John, you're in the middle of this. So as someone who trades a lot of CMBS, and it sounds like your emphasis being subs and challenge bonds, how would you view this market right now? What are the trends and what's important?
Sure. Because we trade the riskier subordinate pieces in these deals, it's critical for us to look into the future and predict how some of the current delinquencies will be sorted out. And then also analyze very carefully the risks of the maturities that are upcoming this year and into the years into the future, and analyze whether or not the funding will be there for certain asset classes. The BBB bonds that I said are at 65 or 70 average price. You ask, well, why are they trading at those levels currently? Well, the average delinquency rates across the conduit deals are only 8 or 9% across those asset classes. Those levels of delinquent loans multiplied by the loss severities across enclosed mall, hotel, office, et cetera, don't really warrant those trading prices. And so in these BBB slices, in this subgroup of loans maturing in the next 4 years, currently are facing uncertainty with the enclosed mall loans in these deals. There's approximately 25% of the conduit deals have enclosed mall loans that mature in the next 4 years. Many of those out there, like Carl Icahn has been on the CNBC boasting about his shorting of the derivatives tied to the CMBS 6 BBBs that currently is trading at about $73 price. Many have been thinking that the maturities that were coming up before COVID has struck us would have issues obtaining new financing as these maturities rolled off, as some of the risks in the enclosed mall space have worsened because of the internet age and the higher dollars spent through Amazon. And so people had been negative on the enclosed mall space to some extent before the COVID had hit. The numbers aren't that significant on the decline of NOI, only a few percent over the couple years preceding before the pandemic. These aren't really, it might not have been such a great bet. One of the things that's helped with to scuttle, and I think that many that have this big short on are misinformed and really aren't modeling what the actual outcomes will roll off as a result of this pandemic. I believe that even though the cap rates across many of the more distressed malls that require an appraisal from the special servicer, so we've got dozens and dozens in our databases tracking all of the appraisals across malls. They're at 10% as a best case scenario. 10% would give you a 150 LTV on loans that were issued 10 years ago at a 6% cap rate. Many of the appraisals on enclosed malls are at 12, 15, 17, 22, 25. We did a study. I don't know if you have my slides, but I could explain that we took all the malls maturing in the next 4 years and took the NOI on every loan. We don't care if they're currently there's 10 billion maturing in each of the years over 4 years. So that's 40 billion. The 40 billion currently has 18% of those loans that are currently delinquent. We ignored if they're delinquent or current, and we put a cap rate on the NOI, the trailing NOI. We found that at a 12% cap rate, 74% of all of the malls in the securitization market are currently underwater. So this is one of the reasons why the value of the enclosed malls have declined for various reasons. It's a distressed market. Now, I own the triple B and the double B pieces with my own money. I own about 125 million of exposure across mainly all this stuff. I'm not hedged, and I believe that the securities that I've selected will have a positive outcome and yield maybe 15 to 20% returns. Now, you'd ask me, well, how on earth would you buy these levered securities in the face of the upcoming maturities where these malls do seem to be upside down? The answer is that the special servicers in these deals, instructed by the pooling and servicing agreements, are under a fiduciary responsibility to take the net present value and determine whether or not a liquidation is more appropriate. Well, liquidating at a 15 or 20 cap rate would just annihilate all of these at-risk enclosed malls. Many of them have 1.7 to 3% or 3.0 debt service coverage ratios for the ones that are current on their mortgages and don't have any problem continuing to make these mortgage payments. I believe that the special servicers, from interactions I've had with them to date, and I'm proud to say this, that these special servicers are going to do the right thing and give flexibility through loan modifications and extensions throughout this industry. It's critically important that this occurs. Many of the enclosed malls across our country are so important to these communities. They've been providing community centers and jobs, and let us all go and socialize together in so many ways and sort of get away from being so addicted to the screen time that these darn iPhones have drawn us all into with so many hours per day. Doing in-person shopping and socializing as human beings is so important. And so I'm really hoping that through the special servicers, they'll continue to do these loan mods. There's already been a number of loan mods. Brookfield just did a loan mod on Tucson. We bought the Ds and Cs in the 40s and sold them in the 50s. They're up 30 points or so. There was a SASB, the BBUB's 2012 TFT deal. Everyone thought that we were crazy buying the Cs in the 50s, and that this one mall, Tucson, that was the weakest of the three malls, was upside down. It was like a 1.8 debt service at the leading mall in Tucson. I was like, they're not giving it back. And in fact, with that cash flow, they're not giving it back, and they'll get an extension in 2 seconds, which just occurred a couple months ago. My analyst, Isaac Maya, actually coined a very interesting, we wrote a research report about how important this particular loan extension was. They had requested a 30-year ammo, so they'll be dribbling a little bit of money into the deal instead of being an IO, making that LTV go down. They agreed to have the debt yield on this particular mall go from 6% to 7%, and as a carrot of having NOI go up or paying more into it, they would be granted a second extension. This is a matured loan, by the way. Then this is Brookfield requested a third extension if they could hit an 8% debt yield target. Isaac actually, as we were writing this research report, coined the title, "The Roadmap to the Future." The performance of the enclosed malls will be critical to the performance of many of the single A, triple B, double B, and single B securities across conduit that I've said are currently trading at depressed prices. So the uncertainty regarding the maturity wall facing the enclosed mall industry, I think, is overblown, and that it doesn't really matter what the cap rate is today. It could be at 15%. It's a moot point. There's cash flow there to continue to service these loans, and so I believe that the tailwind of the consumer that I discussed earlier, the continued spending, and the performance of the malls themselves. Simon reported, for example, that on their last quarterly earning call, that the sales per foot on our nation's malls are now at 117% of the pre-COVID numbers. So that's very powerful. This consumer spending is real. The traffic, we recently purchased the Placer AI cell phone traffic data. The traffic data across almost all the malls that we're following has the human traffic that now is exceeding the pre-COVID. I believe that's a little bit of the pent-up demand and what I like to call the caged animal effect. You know, all the animals get caged, and when they get out, they just go nuts. So they're out there trying to use their vehicles and go out and get the heck out of their homes and interact. So.
Yeah, no, I think those are great points, John, and I think the key in so much of what you're saying is looking away from just the basic data of whether it's debt coverage, whether it's LTVs, whether it's cap rates, and really what's the importance of the asset, what's the durability whenever we're thinking about resilience and how that affects everything else. As expected, of course, these topics are so deep that they're taking a lot of time, so I just want to make sure that we keep everybody moving here. But really, certainly, if anyone has any questions, we haven't seen anything come through the app yet, but feel free to contribute those. But now moving on to COP26 and climate change, this really gets to the heart of the conversation. So Chris, what are your thoughts on regulation and transparency and the objectives of various pronouncements?
Yeah, I mean, the administration has put forth some very aggressive targets. There's the 2050 and 2035 dates. That's the net carbon neutral as a country, 2050, net carbon neutral in the production of electricity, 2035, and then just recently, the objective to get halfway to the 2050 goal by 2030. These are real challenging but achievable objectives, and it's going to result in a significant amount of infrastructure spend. So especially with regards to the production of electricity, the electrification of the economy is significant, and that means we're going to need a lot more electricity than we're currently generating. And the objectives of the administration are to have a significant amount of the new energy capacity come in the form of renewable. So the classic examples of solar and wind, and then nuclear. And on all three, the Department of Energy is looking to try to help lean into these areas, whether it's on the wind space, offshore wind, whether it's in the solar space, commercial solar. Why does resi solar enjoy a readily financeable ABS market, but commercial solar does not? And can the Department of Energy step in and help untangle some of the tangled wires? On nuclear, where can nuclear 3.0 or small modular nuclear reactors fit into existing facilities of coal and coal plants utilizing rail, water sources, and things like that? So there's a lot of interesting areas to explore, and financing is going to be needed on all of that. And it's not even a particularly large step to see how securitization finance can be an important component in this extremely large infrastructure build that we're going to see over the next 10, 15, 20 years. And so, we're interested in talking to market participants about ways of partnering up and working together to try to teach the capital markets or bridge to the capital markets such that we can access this style of financing for the projects and programs that we're seeing.
Great, thank you. And really to bring it all together, Keith, when we think about sustainability, ESG, all of these factors, does this really come down to a question of providing a label and verification, or is it just these are a core part of decision making now? I mean, certainly we have the ERISA decision, but outside of just pension money, from an issuer's perspective, do you just think this is just what everyone will end up doing instead of ending up with a verification that says this transaction or that transaction has followed a set of guidelines?
You know, I'm working with the rating agencies now in terms of looking at the different labels and thinking about how do we think about the data, and are we just going through the motion? I truly believe in, at least in the social atlas that we really deliver is really focused on access and affordability, which can be measured through technology, it can be measured through influence to GDP. I was thinking about what Manish said, he was breaking down our GDP here in the US, and I often think about healthcare as a component, a driver of that, which is relevant, 18%, 19%. And we're now at a point where taxation and or tax collection has been impacted by the pandemic. I also believe that the labor force has now changed. The mix of those two things is going to create more of a gap. And so as people want to think about new investment types, I truly believe from a timing standpoint that ESG overall is going to have influence, but there's certain pockets within the social element for which we can create new products. And when I think of healthcare in particular, you know, the way healthcare was originally designed, we kind of assumed everyone lived for a period of time back in the 1940s, 1950s. It just so happened through great technology, people start to live longer and longer. And the predominant of our funding goes to the elderly. That's great. It's supposed to deal with some of their chronic conditions. It just so happens that as those conditions become more costly due to today's technology, we still have a much bigger audience of folks that still need to be attended to. You know, we've been fumbling around this concept of recovery, but I really believe that this infectious disease is just a reflection of more and more to come in terms of respiratory issues, and how do you deal with that? I know John was talking about tracking people in the mall. We focus on geofencing, track people as they're going through the mall or they're going to different locations. How do we track them? And so I know I'm rambling around, pardon me, but I think there's areas in which we can influence through sustainable financing models and being creative to come up with a new mechanism to help us not just with the recovery, but create a new asset type, leveraging structured finance.
Certainly. Yeah, it sounds like then it becomes a part of everything, which means that it flows through rating agency decisions, verifier decisions, and then eventually investor decisions, just because of its more robust nature. Mm-hmm. We have about a minute left, so I figure I'll put Manish on the spot then to finish out and have a time limit on it. From an investor's perspective, this raises the questions of ESG as an asset class versus a component of investing. And I know this is something he and I love to talk about, and usually it's an hour-long conversation, so we'll condense it to 45 seconds. What are your thoughts on that?
That's right. I think, you know, what do investors want? I think it's very simple. You want something which is AAA, pays 10%, and has a term of 1 year. That asset class doesn't exist. But you know, when it comes to ESG, I think from the investor perspective, the pathway to scalability is getting some uniform metrics out there. You know, when it comes to the E, which Chris is focusing on, there are some metrics. When it comes to the S and G, it's very amorphous and nebulous. We know it when we see it, and this is the other thing which I focus on. You know, if you are an equity investor, God forbid, by the way, then you have more nexus at the S&G point. You get to vote quarterly and so on. Whereas as fixed income investors, your point of insertion, you know, and I say this as someone who worked at Lehman both pre and post bankruptcy, as fixed income investors, our insertion point in the management is usually when things are too late, when there's been a credit event. The entities we invest in are brain-dead SPVs by design. So I think people are giving a little bit more thought to it, but I think over time, ESG will become similar to a credit, interest rate, FX analysis. It'll get embedded in the DNA of asset managers and investors. And to me, what's especially interesting at ESG, there are a couple of very interesting decisions out of the government. But let's keep in mind, a lot of ESG started 6-7 years ago, and this really was bottoms up, where you had end retail investors putting pressure on their asset manager, pension fund, et cetera. And that's how a lot of the ESG started. So I think over time, we will start to see more uniform metrics. And that's really the road to scalability.
Can I add one thing to this? Before we close, there's I heard you mentioning about the government, and that made me think about our industry as a whole, of how we've all been joined together for the securitization bond markets. Many times in the past, I've highlighted different issues and sort of had the courage to speak up about things that I think are impacting us all in a negative way. There's so much financing that we can deliver across all these asset classes. It's quite important. There's something that I noticed that's going on currently in the CMBS area. There are certain participants that are buying the control pieces across these CMBS deals. They're shorting the derivative indexes, and they have all the intentions of trying to direct the special servicers to actually scuttle the properties and go against the net present value that the special servicers are required to conduct to bring back the most dollars into these deals. Some of the short players are actually buying these control pieces and intend to liquidate them at 10 cents on the dollar if they possibly could. I think that's wrong. I think it goes against everything that we've done to create the securitization industry. It just doesn't really have any place in trying to profit off of behaviors that seem to me to be unethical. That's number one. Okay, so I can just say that. I don't like it at all. Number two, I believe that the government has failed our industry in some of these areas. I'm very disappointed to see all of the aid that's been delivered into the airline and the cruise line industries and into different parts of the healthcare industry. Our industry specifically has been completely left out. There was some partisan infighting in the Senate and the House. There were some initiatives that may have provided aid to the hotel and the mall parts of our CMBS. I'd really like to see the government restudy that. This virus is very, very contagious, and it continues to pose very significant risk to the economy and many of these assets. And I'd like to see maybe this industry trade group continue to press on ensuring that various programs, I'd be happy to collaborate to suggest what those might be, that would be there as a bit of a backstop to help many of these particularly hard-hit sectors of our area that provide so many jobs to Americans. Anyway, I just wanted to add that. Those are things the government may help, and us together in our industry may all kind of collaborate to address.
Thank you. So thank you to the panelists. I appreciate everybody taking the time, and certainly thank you everyone for attending today. We hope you found this as useful as we found it enjoyable.